Hi, I'm Michael Taila, Director of Fixed Income at City National Rochdale, and welcome to this month's edition of Fixed Income Perspectives. We begin this month's edition at a time when uncertainty has created historic volatility across the financial markets. Since early April, wide swings have been driven by tariff-related policies and exacerbated by criticism of Chairman Powell and concerns over the Fed's independence. Within weeks, however, the tone has cooled and markets seem to have found some footing. For context, 10-year Treasury yields shifted by roughly 50 basis points over the course of a few weeks. These sharp yield swings caused the U.S. Treasury index to rise and fall over 1% during the month before ending in the black. This volatility also had knock-on effects across risk pricing that initially led to a widening of credit spreads that also quickly reversed as sentiment improved. We've also observed material changes in technical support across taxable and tax-exempt markets, such as mutual fund flows, which turned negative but have since stabilized. Despite these trends, as the dust settled, returns were modestly negative on the month but remained positive on the year, except for municipal bonds. The April 2nd tariff announcement and ensuing market volatility promoted fears of a sell America narrative and that foreign buyers were fleeing U.S. debt securities. The 10 and 30-year Treasury auctions on April 9th and 10th, when yields were surging, intensified the notion that trade policies would erode the attractiveness of U.S. assets. However, allotment data released after the auctions showed little cause for alarm, as foreign and international interest remained in line with averages since at least January. Further underscoring the support was the strong result of the most recent 10-year auction in early May. While longer-term trends have pointed to a reduction in U.S. Treasury holdings over time, recent activity has temporarily alleviated this worry that buyers were avoiding U.S. securities markets. April volatility also spilled over into the municipal market with a roughly 80 basis point rise in yields in just a few days. The significant move in municipals was driven in part by forced ETF and mutual fund selling, a heavy new issue calendar, and investor liquidity needs for tax purposes. These events pressured the municipal bond market, but were technical in nature, not the result of a credit stress. The health of municipal bond issuers remains solid, and most sectors are well positioned to manage through an uncertain federal policy landscape. Coupled with attractive higher yields and valuations that remain above recent averages, municipal bonds offer investors in high tax bracket an opportunity to capture compelling tax-efficient cash flow. As summer approaches, fixed income markets will continue to be shaped by a mix of economic data and evolving trade policies. At the April FOMC meeting, for example, the Fed held rates steady as expected, but signaled a wait-and-see approach amid uncertainty surrounding tariffs, tax proposals, and inflation. Recent economic indicators, particularly the labor market, highlight a stable underlying economy. Trade tensions, including a UK deal and constructive dialogue with China, may reduce headline risk and improve market fundamentals. Still, volatility persists across rates, and we maintain our outlook for 1 to 2 rate cuts this year, with the 10-year yield likely to trade within a 4 to 4.5% range. Despite this, credit conditions remain solid, especially in investment-grade municipal and corporate markets, where we continue to find opportunities we have not seen in at least several years. Thank you for watching this month's edition of Fixed Income Perspectives. Feel free to reach out if you have any questions.